Hello and welcome to KYC. I am Sharad Dubey and with me is Varsha Chandani and you are watching NDTV Profit. Our special segment KYC is there and the company on the radar today is Sagility. Of course, on back of earnings, it's buzzing in the street as well. Brokerages are upgrading and interestingly, numbers have been on the stronger side. But the key questions in our segment we are going to be asking about the companies is what would be the margins triggers, going ahead. The street wants to know. Of course, the earnings is very important. But apart from that, there are other things also which we should be watching out for. The second question would be what led to the guidance? Of course, Varsha was hearing the con call as well, and there was a revenue and EBITDA guidance upgrade also. Outlook coming in on the Broadpath, the acquisition was there, and where the cash deployment would be. It's a product-based companies, whether this will be an AI acquisition or another inorganic acquisitions, that is something which we will be watching out for. Also the debt reduction plans, of course, from IPO itself, debt reduction has been there, but will that be complete by FY27? That's the street question which we are looking out for. The outlook on the US healthcare system, what are the important benefits or the impacts which could see, and the demand trends in client additions. A lot of moving factors going ahead for this company, Varsha, but what's the entire detail about the company itself? Where does the company actually stand?
Well, thank you for that, Sharad. Let me explain in a very easy way what does this company do. So basically, this company takes over complex or non-medical tasks that are essential to healthcare but are very, costly for US companies to handle. So, for example, for payers, that is health insurance. So there are two clients for Sagility. One is health insurance companies, and the other one is, hospitals and doctors and clinics. So for payers, that is health insurance companies, what Sagility does is they handle the claim process, then ensuring that claims are validated and paid accurately. They also provide data management services in onboarding and verifying their health providers in payer network. For hospitals, what they do is they manage end-to-end management of financial operations from pre-service insurance verification to post-service building. So basically, all the back working is been done by Sagility Healthcare, and that's the product-based company that Sharad was talking about. So it's nothing but the non-medical task that doctors, clinics, all health insurance companies that couldn't do is hand over to Sagility, and that's the basic business model of this company.
Well, that's a very interesting and a very simplified way. Thank you very much, Varsha, for that. But our viewers are waiting for what are the key parameters that will be judging them, this company on the KYC itself. Let's just go through the parameters and then we will go into the income statement first. Of course, balance sheet, cash flow, return ratio, shareholding, street cred, and valuation and outlook. These are the 8 parameters where we will be judging the company in our show KYC. First of all, income statement. That's something to look at. Numbers are pretty good. Varsha has also picked up some numbers over here, and if you see the overall data itself, it's not very big because it was recently listed last year itself, but overall the growth numbers, the revenue jump, that's been significant. EBITDA margins, they have maintained. EBIT margins, you could say flattish, but on the higher side at 26%. But look at the PAT numbers, that's what the street actually likes. 590 crores in FY24, FY25 it was 810 crore rupees, and the main reason for the stocks buzzing in today's trade as well is the Q2 performances. The performances came overnight. There was a 25% year-on-year growth coming in. Revenue, EBITDA also the story remains same, slight dip in margin but still at a healthy levels of 26%. But here as well, second time net profit takes the cake. Almost 84% up on a year-on-year basis, and the margin trajectory itself that has been good, and we could say it's kind of stable at 26% plus. So from my side, the income statement, this would be a thumbs up. Nothing much to be concerned about regarding this income statement. I'm sure there's something in balance sheet. What you're looking at?
So, a very interesting case when it comes to Sagility's balance sheet, and one of the reason, why the net profit, there's been huge spike in net profit is because of lower interest costs. Because if you see their balance sheet, look at their balance sheet, their borrowings from FY24 from 1,934 crore has been reduced to 690 crore. And they want to go debt free by FY26. So overall, if you see the highlighting factor in balance sheet is nothing but the reducing figure of borrowings, and that's the reason why we have given a thumbs up. Nothing much to be added, you know, when it comes to balance sheet, because this is the only thing why we have given a thumbs up. And when a company had come with an IPO, they had clearly mentioned that they want to, you know, cut down their debt, and the IPO proceeds are being used to cut down the debt. And by FY26, by end of FY26, you'll see this company may go to you know, debt-free status, and that's where from FY25 to FY26 you will see a huge spike in net profit because of the reduced interest cost only. So thumbs up from my side when it comes to balance sheet.
Well, that's a very interesting point Varsha made. But cash flows, Varsha, looks kind of optically very strong. Operating cash flows have jumped up from 973 crores to almost 1214 odd crore rupees. PAT has also been a good number, and Varsha had stated earlier that this number might go up as well as the interest costs come down as company pays out its debt. Cash flow to PAT conversion, that has slight dip has come in if you compare that with FY24 itself. Net cash flows, there is no clear trend as such, but interestingly I would just like to point out that in this FY25 itself, there hasn't been much in the net cash flow segment. So net it's neutral. It's not very superlative as what we saw in the income statement or even the balance sheet. But from my side, it's going to be a neutral rating going ahead.
Right, you know, talking about the ratios, let's see what that number pans out to be. From in FY24, if you see, the ROC was around 47%, which has increased to 55%. Now, this is on the back of the strong financials that the company has seen. So, again, because of the good, rather, you know, increasing income statement, you're seeing this number go up, and one of the reasons why we have given a thumbs up when it comes to return ratios.
Well, that's pretty interesting. So till now, I think we did 4 parameters, and I think 3 of them they have done really well. What matters is numbers, what matters is earnings, and the company is showing. But let's look at some other numbers also. It's very important. And shareholding numbers we crunched, me and Varsha together, and over here, not much history because it's just been 14 odd months since the company has been listed. But look at the numbers. Promoters, of course, they did sell their stake, but FIs lapped up. They have doubled their exposure from 3%, now it's at 6 odd %. And interestingly, where the promoters did a sell, DIs lapped it up. Look at that, that's a double exposure going up, 7%, now that has gone up to 15%. We understand flows in the institutional part, but even the retail has not, you know, left behind in the race. They have also almost double, you could say, from 7% to almost 12% in the shareholding pattern, and this is just a change happening in just 6 months. So that you can see how important this important number is there, which is flashing on your screen. So from the shareholding pattern perspective, I would like to give a strong thumbs up as well for Sagility.
You know, talking about the street cred, there now, you know, if you see, we have given a thumbs down because company has not given much returns to its investors. The year to date, if you see, the return has been mere 1%. The last 6 months, company has seen 21% of returns, and in last 1 month it's 19%. I'm not saying that this is a very bad number, but not exciting number, you know, to be said. So overall, we have given a thumbs down, considering not an exciting returns that the company has given.
Well, that's true. When the returns are not exciting, what happens? The valuations turn a bit favorable. And that's what's happening in this stock as well. The price to earnings, the EPS numbers, there have been, you know, slight jump coming in, but the P numbers, that's what I'm looking at. FY26, the numbers state at 31 times its price to earnings ratio, and for FY27, this comes in at 25 times. It's largely net in line with what the peers are having in the mid-cap product IT space, and a strong up moves is coming, at least in this space as well, because there is a hedge if you compare that with big service IT company players as well. From my side, it's a neutral rating. Nothing much to talk about, especially regarding the valuations. Let's give it more time, and then maybe we'll have some more information on that.
Yeah, on to the outlook, you know, which is the last parameter when it comes to the KYC ratings. Overall, if you see, the H2 and Q3 and Q4 for this company will be very good. So they are expecting this strong momentum to continue in H2 as well. Now, the important point, and maybe one of the reasons why the street is excited, because that's showing into the stock price, because they've increased their guidance, their revenue guidance to 21% revenue growth from 20% in last quarter what they've given, and they've also increased their adjusted EBITDA guidance to close to 25%. Debt to equity, debt will be fully repaid by FY27, and synergies is also expected when it comes to their Broadpath clients. So overall, Q3 and Q4, considering a strong quarters for the company, they're expecting this strong momentum to continue. And overall, the outlook, considering the deal wins, considering the Broadpath synergies to the business, considering the revenue increase in revenue guidance, we've given a thumbs up when it comes to outlook. So overall, yeah, I mean, from an outlook perspective, it's a good one.
Yes, and we did have a problem while we were discussing that what are the negatives for this company, and of course most of the parameters actually stood out. And just to get in our viewers who are just tuning in now, the most important thing is let's just revise all the ratings which have happened in the KYC segment. 2 thumbs up coming in, income statement and balance sheet. Cash flows largely neutral. The information is also on a limited basis. Return ratios, Varsha had pointed out, they are on the positive side. Shareholding also, we have given a +1. Street cred, not much returns coming in for shareholders who are holding the stock, say after the listing. Valuations still on a neutral basis. And lastly, outlook. That is what the street is cheering, Varsha. That overall there is a strong momentum coming in. So from our side, 6 out of 10. That's on the higher side we generally give when we have a KYC rating, right?
Ratings.
So I'm of course new to this show, but Varsha is quite helping me a lot in this segment. But there's another person who will help us a lot in this segment, and that's the management of the company. Joining us, we are having Sarvabhauman Doraiswamy Srinivasan. He's the Executive Vice President and the Group Chief Financial Officer at Sagility. Good afternoon, sir. So first question, of course, would be the street is asking, is the second quarter numbers, but more than that, it's the con call. In the con call, you had stated that there is an increase in the guidance for the revenue and EBITDA. There is a slight increase in both sides. What led to this? What are the factors that led to you increase the guidance going ahead?
Yeah, firstly, thanks for having me on the show. Like we said on the earnings call, the synergies that we worked with Broadpath, the improved operational performance. In the last few years, the company has been consistently investing on new gen technologies, and AI has helped us improve our profitability significantly by almost 100 plus bips in terms of the operational performance. What we do is core to our clients' operation. So it's not a discretionary spend, which means we are fairly in I wouldn't say a risky, but in a recession-proof sector where our revenues are stable. We are not a fast-moving company. We are a slow, steady, gradually moving up company. You can expect sustainable results. And from a margin perspective, the new wins that we have done gives us the confidence to have a better set of numbers going forward or in the near term. So in our business, H1 is fairly softer in the sense like though it has grown year on year healthily. What we see is the open enrollment season that comes up, and with the acquisition of Broadpath, Q3 we expect a lot of work on the open enrollment season. So Q3 is likely to be significantly a good quarter compared to Q2.
Understood. Hi, Mr. Srinivasan. This is Varsha this side. You were expecting some dilution in EBITDA margins because of the Broadpath integration, considering Broadpath being on the lower margin profile. But still, there's been increase in margin. So just wanted to understand the levers behind the margin improvement.
Yeah, Broadpath acquisition at the time we said that it will dilute by around 120 bips because it's predominantly an onshore delivery. And our onshore delivery in our business, the margins are primarily determined by from where the business is getting delivered. So the offshore being the highest margin generating companies, while the onshore will be slightly lower. So Broadpath is all onshore. So the weighted average will pull it down. But with our operational efficiencies and the technology has given us good performance in the offshore businesses, and our margins have improved because of operational efficiencies and good cost management.
Well, a very interesting point made for these acquisitions as well. But speaking of acquisitions, Mr. Srinivasan, there is a significant cash balance also in the company's books as well. And I always ask a product company, and I always asked Varsha also, that in the entire space, largely it's not about buybacks. That's what we heard from a lot of players in this product space. Are you looking at some more acquisitions? Because there's a lot of cash, coming up in the company as well. Or would there be any way to reward the shareholders, or are you looking at for expansion? And because AI is also the important keyword as well for you.
Yeah, we make slow and steady progress. M&A has been our core to our business. In the last 2 years, we have made close to 3 acquisitions, and we always look for niche capabilities in the sector and also access to mid-tier clients. So acquisitions are always on the lookout, and the company would want to plan its cash prudently. We have debt on the balance sheet. We have a repayment schedule. We would want to clear that out soonest. And as a small step towards giving back to the investors, we have started with a very small dividend, but that's more to show the intent of the company. I'm sure we would want to reward our investors as well, but companies' intention is to invest in the right areas and grow forward and take the momentum that's there in the market and use the opportune moment. And that's why we would want to conserve cash for our M&As, repayment of debt and stuff like that.
Understood. Also, Mr. Srinivasan, now you are expecting to be net debt free by FY27. Just want to understand how this is gonna impact. Of course, this is gonna impact positively to your PAT. But any target number that you've set for yourself with respect to PAT margin, considering the lower interest cost or zero interest cost by FY27?
See, you can do the math yourself in terms of once the interest goes out, what's the PAT will be. But we have not really set out a target. But what we would want to do is invest strongly in technology and new age technology, invest more on client relationships and expansion into the sales. And how do we grow? Because we feel that for our business, the margins are healthy and of course aided by AI and other technology that we use as part of our operations. And we would want to reinvest back into the business and take the momentum that's available in the market today.
Understood. Also on to the Broadpath's revenue, because I believe the Broadpath's revenue would be higher in Q3 and lower in Q4. Is the trajectory to be same? Will you see impacted Broadpath's revenue when it comes to Q4?
Yeah, Broadpath's revenues will not be as high as Q3, but Sagility's organic business has a good Q4. So from a market, the street may not see the difference, but what we think is Q3, Q4 are going to be healthy, and our H2 overall will be definitely better than H1 in that sense. So it's a seasonality that we have. We have a pattern in the business, and Q3 growth largely driven by Broadpath and Q4 by Sagility. Of course, Sagility Organic also has Q3 growths.
So basically, Mr. Srinivasan, to just kind of make it more simpler for our audience, there is a hedge happening. One is a Sagility's business model, and of course the new acquisition which you have taken in. So you are trying to actually remove the lumpiness which we see in a year. So in order to do that, maybe the merger and acquisition which you might have in the future, they can help you out in your H1 numbers. Am I right?
Yeah, it could. It depends on which target that we are pursuing. But broadly, in this industry where we operate, the open enrollment season is somewhere between October and January. So that's where there is a spike in margin. But otherwise, what we do is core operations. The revenue is likely to be stable. We are looking at newer areas of supporting our clients. So the growth has never come from taking wallet share from others. It's doing more newer areas and newer capabilities that they have never offshored. So that's the key focus. it's newer capabilities is our focus.
Mr. Srinivasan, what will be these new areas which you were talking about? It's a very stable business model. You had pointed out earlier in the IPO as well in today's interview also. But just give us some more flavor about these new areas, what it is, which are the categories, where some inquiries are coming, where you might be building a product around it. Can you just give us more light into it? That will be very important so that the future outlook of the company comes in our show.
Yeah, traditionally, most of our companies in our space, we have been doing a lot of administrative work. Now there has been a significant focus on the clinical space. So if you look at a dollar premium, almost 70 cents of that premium, 70 to 75 cents of that premium goes towards the medical care or supporting the medical care. And the balance 20 is towards profits, other expenses, and all the administrative cost, including IT. This is for a payer organization, I'm saying. So we are now trying to get into how can we help support using our AI into the medical space as well. In the sense, like, for example, if there is a prior auth coming in and it's an unstructured document, it's a medical record of 70, 80 pages. So we have deployed AI technology where it can cull out relevant portions that are required for a particular surgery or a treatment, and then it compares it with the insurance policy that that person has taken, and it helps the nurses with all relevant data fields available on a single screen to make better decision making. And then the more you click on, you just go and validate what the AI has done. So the machine learns by itself. It improves efficiency, broadly bringing the average time taken to solve a problem. So thereby, the resources that we deploy in are the cost is lower and hence resulting in margins. So we are trying to get more into the clinical areas. And Ramesh yesterday on our CEO on the earnings call explained about 4 or 5 use cases of Gen AI. So we are trying to get into more into the clinical space as well.
Understood. And sir, on to the, so we all know that US healthcare is going through challenges when it comes to rising cost or, shrinking margins and growing regulatory complexity. How this is impacting Sagility as a company?
See, rising cost has always been a challenge in the US. And so it could always be an opportunity for Sagility because when my clients wants to take out costs, then obviously companies like Sagility become the first choice in the sense uh, the more proven expertise, deep domain expertise that we have got. Sometimes we understand more than our clients in the way we operate their systems. So it's because the team has stayed together. We have done a lot of good work in deep operations, and we understand and tell the client as to which are all the areas that a technology, when deployed, can be very effective. Rather than me, a company going with a set of AI developers to say, hey, what's the problem that you want me to solve? And we don't ask those questions. We know where those can be deployed, where it will work, where it can be more effective. And we help our clients. And we don't charge upfront on an IT development. We try and solve it and reduce their operation cost. And the gain share model is worked between us and the client.
And Mr. Srinivasan, you spoke about clients. The client addition trends, how is that actually panning out? Will you be adding more clients in your new areas, where you're looking at, or the client stickiness continues for your old business as well?
It's always a wish list to add more clients, but in this space, it's not very easy to add clients. The sales cycles are very long. But obviously, our client relationships are very strong. We have multiple touch points at multiple layers. We have touch points with our clients. So obviously, the existing clients will continue to grow. That's our intent. We want to grow, and I can't say no to a business from my existing client, or I don't want to say no to an existing client. And yes, we are wanting to add more clients in the mid-market segment. We are trying to come up with a BPaaS opportunity that, again, Ramesh explained yesterday, where we want to take up the entire operations of a mid-tier or a smaller player and do an end-to-end service for them. So we are trying out newer areas.
Well, that's very interesting. We're trying out new areas, and of course, we can say Sagility does have some agility. But thank you very much, Mr. Srinivasan, for joining us and talking about your company and its growth and future plans going ahead at our show at KYC.
Thank you.
Well, moving on, that's it for the show. Thank you very much for joining us, and thank you very much, Varsha, also for the information and the help for this company as well. Keep watching NDTV Profit.